kind of early this year, I think it's a mindset change from investors' perspective, from regulators' perspective, for technology companies, for enterprises, for consumers. Everybody is all of a sudden aware of something they weren't really aware of, weren't thinking about literally a year ago at this time. And that's changed people's perceptions of where they want to put dollars to invest from a growth perspective, where enterprises are making investments. And we've obviously seen that play out given the amazing growth in NVIDIA's GPU demand this year, which has driven that stock to kind of amazing returns, obviously, in the last year. We're all coming to grips with that new dynamic and what AI is going to do from a returns perspective, what it's going to do from a societal perspective, what does it do from an inflation or interest rate perspective, what does it do from an employment perspective, what does it do from a cost perspective, and trying to make sure we understand all the implications of AI across all those different dimensions, and make sure that we're incorporating that analysis in those kind of 5-year forward internal rate of return analysis as we're doing in all our companies.
Please share with us what you have learned so far. And I feel like this is early days, and clearly you've devoted a lot of time to it. So the first derivative impact of AI is what, and what kinds of companies has it benefited?
Well, I think the first derivative impact of AI is kind of benefited what we call the AI arms dealers, right? Really the chip manufacturers. It's NVIDIA, it's AMD, it's Broadcom, all been really kind of amazing stocks. Probably Microsoft as well, given some they're a leader with kind of the Copilot options that they have. And I think that those have all been amazing stocks in the course of 2023. Well, I think we're trying to make sure and again, the market's the market has identified this as big winners. The stocks have gone up a lot. We're really trying to think about a little bit more, what is the second derivative impact of AI, not just this year or 2024, but as we think about that 5 years out. And I think there's a couple things I would highlight is, we've all kind of told our children to go become engineers or programmers, learn to code. And I'm not saying it's a horrible decision, but things like GitHub Copilot from Microsoft, it makes programmers 50% more productive. A couple of years ago, it was 25%. Maybe in a year or a couple of years, it's going to be 100% more productive. If you can make a programmer 100% more productive, you don't need as many programmers. Companies that employ a lot of programmers, they're going to be able to grow in the future without adding as much physical human labor as they have in the past, which will probably be positive for their margins. So you can think about companies, whether it be an Intuit, a Roper, a PTC that have a lot of programmers, maybe their margins expand a little bit faster than they have in the past. They can use the productivity tools to their benefit. We've always been in the view, ever since inflation took off, that it would get back to a more normalized level, maybe 2 to 2.5%. I think as a society, as investors, something that we're going to have to come to grips with over time is it'll be disrupt jobs. It'll make people more productive. And that if you have a supply-demand imbalance for human labor, that will probably put some deflationary pressures on kind of the labor cost, and that helps probably drive inflation back down to that 2% or even maybe below for a longer period of time.
How soon is AI going to hit the company?
I think we're already seeing it starting to impact cost structure. I think Alphabet, on one of their conference calls, their CFO, Ruth Porat, kind of talked about, one of the reasons why margins, which have historically for Alphabet going down for since they've been public, now they're going to start going up. And the first reason that she highlighted in that conference call was AI. And, what does Google have? A lot of programmers, a lot of engineers. And, if you can make those programmers more productive, if you can grow your revenues at a, high single-digit, low double-digit kind of rate, you don't need to hire as many programmers. That actually enables more margin expansion than you've had in the past.
And that's actually happening now. I mean, that's something that they're talking about.
Absolutely. They've kind of highlighted, at least in the case of Alphabet or Google, that's a 24 event, that's a 25 event, that's a 26 event, right? That you're going to see kind of productivity out of them and get their margins going in the right direction, which is, again, one of the reasons why we're a little more positive on Alphabet. Again, it's also been one of the names that's lagged a little bit relative to some of the other big cap tech stocks.
Right. And, you wrote a book called Capital Allocation, and I know that capital allocation is, from your Your research is incredibly
That is not my TV.
company
That's the
allocates
PBS channel
their
blinking on and off like that.
R&D or
I don't know what their problem is
dividends.
today.
So
The
are you
weather
looking
is
at how
perfect here,
companies are
but
allocating
they are
to
blinking on and off,
AI
not my TV. But
research
this
and
is
or
a
AI
great
applications?
interview.
Is that going to be an important part, that exercise for you now?
It is. It is. Again, we don't have as much visibility on that aspect of it, honestly, right now.
Right.
Outside of the companies that are very, very public about that. Again, everybody uses AI in every conference call. We have a conceptual view of that and how that impacts certain companies and their cost structures. We are trying to think about not only how they're investing, but who could benefit from this the most, who could benefit from this a little bit, and who could actually be hurt by this on a longer term basis.
So aside from companies that have a lot of software engineers, I'm thinking about healthcare. How does it apply to healthcare, an area that you think is very attractive? I mean, you own United Healthcare, you owned Becton Dickinson, a medical device company. Is it going to have a significant impact on healthcare anytime soon?
It's funny, healthcare probably won't have the earliest impact from AI, but if you think longer term, again, even 5 to 10 years, healthcare is probably one of those areas that could actually have the biggest benefit from AI, right? You just think about radiology as one example, right? GE Healthcare is incorporating AI technology.
That's what I've been waiting to hear.
You can actually train a system, AI system, a large language model, essentially, it looks at 10 million scans and says these are the ones that are most likely to have cancer or not have cancer, and actually give that and then take that analysis, give that insight to a radiologist who can check and say, this looks like it probably does.
Because they're going to do radiology now in drugstores like Walgreens.
On drug discovery,
so
on life sciences, maybe AI can take the place, between.
This is what some of the I've been waiting to hear from someone like him, because I'd like to invest more in GE Healthcare.
5-10 years will be probably materially impacted, in a very positive way, I think, from AI.
Take us through some of the companies that you've invested in the areas that you think look undervalued.
We've always liked utilities. Again, utilities got overvalued last year, so we went underweight utilities last year. Given how strong they've been, but this year they've been really had a lot of pain, right? They've been big underperformers, and so what's interesting to me about utilities is their fundamentals have really never been better. We are in the middle of this transition away from coal and natural gas to more renewables, more transmission, more batteries, and the number of utilities that I can count today that are kind of growing earnings at a 6 or 7% rate, that have a 3.5% dividend yield. The ability to generate kind of a total return of 10% or more with half the market's beta, with really good fundamentals, no Chinese risk, no FX risk, no GLP-1 risk, sometimes like 15 or 16 times earnings. That's really compelling in my mind. And not just on an absolute perspective, I think what's also attractive is people think about utilities as like interest rate plays.
Yes.
That was true in the past, and it's still true to a certain extent, obviously. But most utilities are actually growing earnings at a very, very healthy clip now. A long time ago, all you got with utilities was their yield. But today, you got these utilities that are growing 6 to 7% per year. I would actually argue that the average utility growing 6 to 7% per year with a 3% dividend yield, delivering that 10 or 11% kind of total return algorithm, will actually be a better total return algorithm than the market over time. If you actually look at the last, since 2006 to 2023, S&P 500 earnings growth has only been 6%. So you got utilities kind of growing almost a very similar rate to the market, plus the dividend yield with lower volatility, less FX risk. I think utilities are very compelling, and especially relative to consumer staples. Consumer staples have GLP-1 risk. They have challenges with FX. They have challenges with a variety of other issues, and they trade for higher valuation, so you get slower growth, lower dividend yields, and a higher valuation. I think over time that arbitrage, by having a big overweight in utilities and a big underweight in staples, creates a lot of value in the next 3 to 5 years. A couple of things I would just highlight, like an Ameren, a DTE, an Excel, all exceptional management teams, good jurisdictions, that we see really good value in all three of those names here.
Some of the other contrarian ideas, what are some of the other ones that somebody would say, why would he own this?
Healthcare is another area where we really like, again, healthcare did really well last year, but I think if you can go across the board in healthcare, whether it be a Biogen, which has really great story here around Alzheimer's. They have the best Alzheimer's drug on the market. Rivety is the old Perkinelmer, got spun off, they got rid of their old industrial assets. And now you got a great CEO in Prahlad Singh. You had really good assets at Rivety, trading at 4 to 5 multiple difference between kind of the Danners and Thermos of the world, which we like as well.
What's your one investment idea for a long-term diversified portfolio?
Actually, if you have a 5-year view, I think Revity would be the most. It's been a tough stock this year. Great CEO in Prahlad Singh. It's basically a life science tool company with reagents, software, diagnostics equipment. Again, we think over time, the life science tool space had a tough year this year. I think next year's probably a lot better year. 25 is even a better year for that sector. This is a company that we think can grow high single digits organically, can probably improve margins 50 to 100 bips a year, deploys capital extremely well, probably can generate mid-teens plus returns, and you're buying it at less than 20 times forward numbers. That's probably the most compelling stock we have in the market. When we do that 5-year IRR analysis I talked about, that is today is actually our highest IRR over the next 5 years is that Rivety. The other name we just highlight in healthcare is Becton Dickinson. Becton Dickinson is also a large holding. They've had some FX issues this year where the Mexican peso has gone the wrong way against them. But you think the fundamentals are really strong there. The business is growing faster. Cap allocation is going the right way. Margins are going the right way. They had a major product that came off the market, and Alaris is back on the market now, taking share. So we really like the Becton Dickinson story as well.
And why has healthcare been a contrarian idea? Why has it had a problem in 2023?
If you think about healthcare is not a near-term beneficiary of AI, right? So again, we've had a market dominated by those AI plays, and this has been also a market dominated by higher beta stocks. So we've had a situation here with there's a little lower beta stocks. And also we've had life science tools. It's been a really great sector for the last decade, but we spent a lot of money on capital equipment, on diagnostic systems the last couple of years around COVID, and we have to take a breather, maybe a 1.5 breather there. But I think if you think about the second half, 24, 25, 26, we feel that really, really good about life science tools. The underlying science is really, really compelling.
David, you talk about 12 months out, 2, 3, 4, 5 years out, whatever, and one of the companies that you was a one investment for a long-term diversified portfolio a couple of years ago was General Electric, and I was just thinking, why on earth would he be buying General Electric? And you had to wait for that to pay off, right? But it has.
It's been an amazing stock this year. I mean, industrials have been our biggest contributor to performance this year, and GE is a big part of that, right? And I think it's a really important point you make, though. We have these 5-year views, and sometimes these stocks do really well in 1 year. Like buying NVIDIA last year has been a great investment for us this year. But sometimes GE took us 3 years to get the 100%, to get the 100% plus move, right?
Well, he did great with GE, and I have to shut off the video now. I'm going to watch the rest of it, but this was so informative, and I'm going to definitely recommend his book and buy his book, people.